Hello all, welcome to Shiva Finance Academy. Today we are going to learn about the basic concepts of accounting importance, golden rules of accounting along with few examples. So what is accounting? Accounting is the process of identifying, recording, classifying, summarizing and interpreting financial transactions of an organization to provide useful information for decision making. Now in simple words, we need to identify or recognize financial events which involve money. We have to record it in a systematic manner with the help of a journal. We have to ensure to group similar transactions, and we need to summarize, that is, prepare the financial statements which involve P&L and balance sheet. So that will help stakeholders to analyze the results and make the decisions accordingly. So who are the stakeholders? The stakeholders could be owners, managers, investors, tax authorities, banks, etc. Now, why accounting is important? Accounting is important because it provides financial clarity. It helps measure performance. It supports the legal and managerial decisions. So there are few important parameters of accounting. For example, it helps determine profit or loss. So the first most important thing about accounting is it will help to determine whether the business is in profit or loss. So for example, if a person runs a business and makes a sale of around 10 lakh in a year, his purchases and expenses including everything is around 8 lakh. So if through accounting he can determine total income minus total expense equals to total profit or loss. So in this case 10 lakh minus 8 lakh equals to 2 lakh, it is a profit, and this is the purpose of accounting. It helps manages cash flow. Through accounting, the business can ensure how much is the cash in and cash outstanding. For example, the cash sales are made for 10 lakh and the credit sales are made for 2 lakh. So overall sale is of 12 lakh, out of which 10 lakh is received, that is cash sale, and 2 lakh is outstanding to be received from the debtors. Accounting also helps in planning and budgeting. So accounting helps in planning in a way, since the planning and budgeting relies on the past results. So through accounting, we can look at the past results and accordingly plan and budget about our future transactions. It also provides financial information to stakeholders. It ensures legal compliances such as auditing, tax returns, income tax filing, etc. It helps evaluate business growth. So through accounting, a business can understand what area of business it could be diversified to, where are the opportunities to grow, where are the opportunities to expand, and so on. So in short, this helps assess long-term success and stability. Now let's look at golden principles of accounting. So there are three types of accounts. First is personal, second is real, and third is nominal. So personal account. The explanation for the personal account is a person or organization receiving something is debited. A person or organization giving something is credited. And the rule for personal account is debit the receiver, credit the giver. Let's look at few examples of personal account. So for example, you pay rupees 1000 to A. A receives. In this case, A is a person. So in this case, A receives, that is debit the receiver. So in this case, we'll debit A account, credit cash account. Now take a second example. You receive 5000 from B. So B is a person in this case. So B is giving. So credit the giver. B gives. So credit B, cash is debited. Real account. Real account is asset or thing you can touch or measure. So asset or thing that enters the business is debit. Asset or thing that is leaving the business is credit. And the rule for this is debit what comes in, credit what goes out. Example, business buys furniture for rupees 10,000. So in this case, furniture account is what is coming in. So furniture account will be debit to cash or bank credit. Let's look at nominal account. Nominal account is income, expense, loss, gain. So business spends is debit, business earns is credit. And the rule for nominal account is debit all expense and losses, credit all incomes and gains. So example, you pay salary of 10,000. So salary is a nominal account. We will debit in this case and credit cash oblique bank account. Let's look at few other examples and the summary for the golden accounting rules. So to summarize, there are three type of account: personal, real, nominal. In case of personal, debit receiver, credit giver. In real account, debit what comes in, credit what goes out. Nominal account, debit expenses and losses, credit incomes and gains. Simple trick to remember is receiver is equals to debit, giver equals to credit. Thing coming in is debit, thing going out is credit. Expense is debit, income is credit. Few other easy examples. Mobile recharge for business. This is an expense. So debit expense, credit cash. Customer pays money. So customer is a personal account. Debit cash, credit customer. You buy goods for cash. Debit purchases, credit cash. So that's all for today.